Welcome, everyone. I'm Angelo Robles to Angelo Robles' Effective Family Office podcast, where I look to distill the best practices and best ideas of the world's most successful families and their family offices. I hope to provide thought-provoking opinions and feature amazing thought leaders to our listeners of the podcast with an eye towards the future of the family office. The subject today: investing best practices of the world's best allocators. Our special guest is Ted Seides, CFA, host of the Capital Allocators podcast. I don't think in my 101 podcast I've ever had at least a well-known, like Ted is, successful podcaster until that day that I get Tim Ferriss or Joe Rogan, Ted. So you are it. And by the way, speaking of his podcast, Barron's Best 7 Podcast in Business and Finance and Business Insider's Top 10 Podcast for Investing. Ted is really good. But what I like to do, especially lately, because it helps to have context to our dialogue, Ted has a great background. And that background would be, Ted is the founder, as I noted, of Capital Allocators, through which he hosts and produces Capital Allocators podcast and advises asset managers and allocators. Ted explores best practices in the asset management industry from the perspective of asset owners, asset managers, and other relevant players, and is widely followed in the institutional investment community. Previously, Ted was founder and served as president and co-chief investment officer of Protégé Partners, where he spent 14 years as leading a multi-million-dollar alternative investment firm that invested and seeded hedge funds. He started his career and spent 5 years under David Swensen at the Yale Investment Offices and other business school. Spent 2 years investing directly at 2 of Yale's managers. Along the way, Ted was featured in the well-known book, Top Hedge Fund Investors, Stories, Strategies, and Advice, and authored So You Want to Start a Hedge Fund: Lessons for Managers and Allocators, and very well known, which we'll get to a little bit later, made a 10-year charitable bet with someone you might have heard of, Warren Buffett, pitting hedge funds against the S&P 500. Ted holds an MBA in Economics and Political Science, cum laude from Yale University, and an MBA from Harvard Business School. That was quite the buildup, Ted. How are you?
I'm doing fine. Thanks, Angela.
And I again, you're many first for me. One, you're a well-known podcaster and you're great. I highly recommend your podcast. And as those of you that may be watching this live, and we're hosting this as a live podcast as well as a video, Ted has a mic that is every bit the equal of mine. Wow, we're comparing our Blue Yetis or whatever mic that you may be using, letting in on our podcasting secrets. But I hope you're doing well and family during the challenging times of COVID-19. What I'd like to do, Ted, is I think the subject is so intriguing, investing best practices of the world's best allocators. Why don't we get right to it? Living up to that title, what is the processes that the world's best investors use to game plan? Meaning, is it investment policy statement into allocation, into execution of the strategies? And how has that changed perhaps during COVID-19?
Well, I think it's all of it, right? It's hard to distill into a short verse, but yes, all great investors start with a set of beliefs. And you can call that investment philosophy, but usually there's a set of beliefs about how they think the investing world works, and then applying that to the particular pool of capital that they're managing. So you start with that as an investment policy statement. You then move into strategy, which is how are you going to start to think about implementing that? And that might consider the resources you have at your disposal, internal management, external management, the governance structure, all of those things are part of strategy. And once the philosophy and the strategy are laid out, then you walk into the whole investment process, is asset allocation, and if it's external managers, it's sourcing and due diligence and decision-making, portfolio construction, risk management, and on. So I think that if there are similar characteristics across the great investors. It is that they actually check all those boxes. There are a lot of people that go about investing without figuring out exactly what they believe. And if you don't know what you believe, it's very easy to get whipsawed by the markets and the fads of the day. So there's a tremendous discipline in that. There's a necessity for communication, both internally and externally, because these institutions have very broad constituents. It's quite a bit more complex, as complex as families are, and the many people that you could have in multi-generations. If you're managing a pension fund and you have thousands of people that are your constituents who don't understand investing, and a board that may be a mix of people who understand it and don't, and significant competition and budget constraints, it can be very difficult to figure out how to manage all those constituents. And so having that alignment is just tantamount importance.
And Ted, you have experience both in running the investment aspect of a single family office, of working under the iconic David Swensen, to understanding the mindset of more institutional level allocators, mainly since our audience is more focused on successful families and single family offices. And there are nuances to that, including taxable implications, which often institutions don't have to worry about. How does some of what you just said on investment policy statement that may factor in risk tolerance, it may factor in goals, timeline, tax sensitivity, areas to potentially keep away from, what are some of the key differences you see between single family offices and other institutional level allocators in the game plan and structure of what they look to do prior to executing?
Yeah, I mean, I think in terms of the differences in the capital, you sort of highlighted the main one, which was just taxes. And I think that many more institutions have a more fine-tuned sense of the duration of the capital and the math of the liabilities than families do. But when it comes to that similar structure of trying to figure out what are you trying to do and how do you want to do it in a way that everyone who matters understands and agrees to, that's the biggest challenge in getting investing right. And in my experience, both from the time managing a single family office and in my institutional years with families as clients, institutional investors tend to focus a little bit more on that. And families, as you know the aphorism, when you've met one family office, you've met one family office. And so, I found there kind of some really understand and have a commonality of mission in the investment process, and others never really get there. They sort of move around and change their minds quite a bit. And there's a difference in changing your mind about the investment implementation and changing your mind about the philosophy and strategy. And so that's where I've seen the biggest difference in the two pools.
And given that relatively recently you were the CIO of a significant single family office, take us through a little bit from the investment aspect of it and perhaps how it differs from institutional. You'll see a little bit more Machiavellian in single family offices where one person is effectively the decision maker, they can move quickly. But for larger scale families that have a little bit more rigor and institutional level processes, you'll begin to see more committees, more advisory boards relative to investing. So it's more laborious, but it may provide various second, third, fourth, fifth set of eyes looking at something. How did it work in the single family office that you were? And looking back, what could have done differently?
Yeah, well, I had the opportunity to start to build from scratch. So it was a new pool of capital due to the sale of a business. And so I could take all of the lessons and frameworks and try to apply it. And I say try because sometimes you get it just right and sometimes you don't. So it's a lot harder when you're working with, in this case, a person, in a family, to figure out like what is their risk tolerance, both at the high level and at the individual level. And so we spent a number of months just going back and forth on individual investment ideas to get to the point where I could calibrate the types of investments that were appropriate and what an asset allocation might look like. So we did that. And then it became really a question, once you sort of have an alignment of what that strategy is, it becomes about execution. And so I think the biggest difference with that experience and what I'd done in the past was, as you said, there was a lot more flexibility to do things directly in the market. So we did use external managers, both a mix of active and passive, but for many years until recently, volatility was very, very cheap. So we hedged in a tax efficient way using put options more than we did, say, using a hedge fund that you had to pay 1.5 and 20.
And you mentioned a word that's very common among institutional investors, but many SFOs may not be familiar with it, but aspects of it still apply, potentially to developing an investment policy statement into an asset allocation plan and a execution and distribution plan. And that's the word, mapping liabilities. If you could explain that to an audience and how that may still be impactful to single family offices as well.
Yeah, well, for single family offices, the liability stream is the spending. It's the spending for the families, and that may be for many generations. So, for a university endowment, there tends to be about a 5% inflation, plus inflation spending. For a foundation, it's a legally mandated 5%. How much is it for a family? Well, that depends on lifestyle. It depends on choices. It depends on houses. And it can change over time. It can change over the course of someone's life. And particularly if the wealth is intended to be there for multiple generations, it gets tricky. But the concept is what's the money for? Great. We have money. That's fantastic. All of our clients, all the families, that's wonderful. It's a great place to be, to have money. What's it there to serve? Is it there to serve just the person who made it for the rest of their life? Does it have to do with missions and causes they want to be involved with? Does it have to do with their offspring and future generations? And so you can turn all of that into numbers and then get a sense of how might you want to spend out of this pool over time. And that becomes the purpose of what you're investing this capital for.
There's a gentleman well known in asset allocation circles, Jean Brunel, and he basically talks about there may be different branches of the family. There's different goals of the family. Some goals may be very short term, midterm, and some may be 20, 30 years out, where you could have more illiquidity premium and swing for the fences and not care about short term market gyrations. The challenge with that is if you now have to set up multiple investment policy statements, multiple asset allocations, the tracking of that and the aggregation and reporting, it probably is the right way to do it. But if a family has 15 or 20 different allocations, I mean, honestly, is that realistic? Or is technology making that more doable than ever before?
Well, it's both. Technology is available to allow you to make what used to be very difficult quite simple. Doesn't mean it's the right thing to do. If you have a wide variety of different objectives within a single pool, it might make sense to just regress to the average and manage it as a single pool. There may be efficiencies in doing that. But again, every family is going to encounter a different situation, and what's right for one family probably isn't for the next.
And in terms of, and it's more complicated than I'm making it, but generally when it comes to the asset allocation part, there's strategic asset allocation and tactical. Generally, where do you see a difference among family offices compared to more traditional institutional investors? Does it tend to run 50-50 more to strategic versus tactical? Or is COVID-19 with dislocations in the market forcing the hand of more family offices to be more tactical in their approach?
Yeah, well, I think it's helpful to define those two, right? So strategic is the notion that we understand the objectives of the capital and we can pick a set of strategies, we call it asset classes or whatever factors, doesn't really matter. We pick and we can review infrequently a set of strategies. And if we keep our capital invested in those strategies over a long period of time, we'll meet our objectives. Tactical is trying to beat that by shifting around those strategies. So easiest to think of asset classes. Generally speaking, very, very few people, whether they're individuals, family offices, or institutions, or investment managers for that matter, have demonstrated any ability to add value from tactical shifts. The exception to that tends to be at extremes in the market. So there's a lot of data to support that. You could look at mutual fund data and the returns of the dollar-weighted returns versus the time-weighted returns of mutual funds. We do know from our behavioral wiring that we're humans, and just from human nature, we will chase performance. Every research study on any investment strategy has always shown that in aggregate we chase performance. Yet individually, we all believe we're not going to. So I'm not a big believer in tactical timing, because over time it tends to lose money, and most people remember their winners, they forget their losers, and they don't really add up the added value or detracted value from those shifts. That said, you go into a period like this, and where people do take action that adds a lot of value is actually the antithesis of tactical, which is rebalancing. So when the US stock market drops by 35% in 3 weeks, and then it turns out, 2 weeks later it goes up 20, 25%. Well, allocators, investors had an opportunity, if they had a certain target, maybe a 20% target to US equities, and it dropped to 16% relative to their other assets, they could have added to go up to 20, and they would have made a bunch more money on the margin. And so you do see, when markets are more volatile, you do see a lot more rebalancing. That's actually the opposite of tactical investing.
And a little bit of a sensitive topic sometime, but given that you created an investment-focused family office and have experience as an allocator institutionally and traditionally with families, the area of compensation, does it get a little tricky when the head of the family office or the CIO is mainly judged on perception of returns in the portfolio? By nature, won't that cause them to perhaps be a little more aggressive than they should relative to the family's goals and perspective? How do you help adapt compensation to align it with the family, but you also want to keep the executive, if they exceed, whether hedging certain risk, benchmarks, whatever are used, some level of bonus compensation if they exceed an average?
Well, alignment of incentives is the key. And so I had this lesson very, very early in my career. And it wasn't from the family office perspective, it was from a manager perspective. So there was a very successful long-only manager called Chieftain Capital back in the day when Glenn Greenberg and John Shapiro were together. And they had a flat 2% management fee. And when they hired their analysts and associates, they didn't pay them with the bonus. They just paid them an abnormally high salary that they paid them every month. And there was no bonus. And I really scratched my head at the time, because that just what you never saw that anywhere. Well, it turned out that they were trying to invest for the really long term. They didn't care what happened at the end of every year. They didn't want to reward people based on what happened every year. They wanted people thinking that this is a pool of capital that's going to compound over time. What a terrific alignment with the heads of the firm, their team members, and their clients. And what happens in family offices is you have this tension between investment professionals that want to be paid as if they are managing a pool of capital that has an asset-based fee and maybe a performance fee, and a family who generally wants to keep their money. And those tensions are natural, and it's up to the head of the family office and the family to figure out what will work over time. So if the family isn't interested in them shooting the lights out, then they can't pay them for shooting the lights out. But if they want someone to be there for a long time, they may need to pay them very, very well through thick and thin. So there's a lot of different ways you could think about that alignment, but it's incredibly important because incentives drive behavior.
Indeed. Let's go around and look at many different asset classes, for lack of a better word, get your opinion, and as well as your insight to what many of the world's greatest allocators are doing. We'll start with the most obvious one, I guess. That would be simply public equities. So we look at the S&P, hit a low on March 23rd. Today is April 27th. It's up today. Overall on the year, it's down, and a lot, 15%. But you would think from looking at the economic numbers, unemployment, and the devastation by COVID-19, it probably should be down 30 or 40%. We're going to make the assumption that it somewhat is, I'm not going to say artificially propped up, but maybe I will, by significant stimulus packages to kind of keep things going. But of course, adding to our deficit, which could be a big problem at some point soon down the road. So how are you seeing allocators, perhaps that want to be tactical during this dislocation? Are they looking at, oh yeah, the winners, they're pretty obvious to identify: Amazon, Walmart, Zoom, Netflix; the losers, airlines, cruise companies that are public, movie theater companies that are public. How are the best allocators looking at this and being tactical? And what are some trends that you're seeing?
Yeah. Well, the question really isn't who are the winners and the losers. The question is what's priced in and how are the winners and losers going to differ from market expectations. And so you just start at that level. I mean, the allocators that I talk to have very long time horizons. The pools of capital behind them, endowments, foundations, sovereign wealth funds, large family offices, they're not investing for the next week or quarter or year or 5 years for most of the time. And so they've all followed effectively a similar playbook without talking to each other through this time. So the first step in that has been kind of the obvious, which is how do people communicate on the team? It's a different work environment. I think that the people in these seats actually have the benefit of small teams that travel a lot. So they're accustomed to not necessarily all being in the office in the same day. And they don't have a lot of people to figure out how to communicate with each other. So that doesn't take too long for them. The next step has been this calibration of what's happened to the portfolio. And before you can take action, before you can be tactical, you need to understand where you are and what's happened with your assets. And the most unique part of this time is that because of the sudden stop in the economies around the world, it's affected the businesses on the other side of the assets more than any time before. So let's start with hospitals. So say you're managing a pool of capital for a hospital. We know that the hospitals are doing everything they can to address this disease. We also know that all sort of optional procedures have been put off. Well, it turns out from the business of a hospital, dealing with COVID-19 is very low margin, and doing orthopedics is very high margin. So if you're managing the pool of capital for a hospital, you need to understand if the hospital is going to lose money and how much before you can say, oh, I have 2% excess cash, let me go invest that. If you're managing a university endowment, what happens if schools can't open in September to your freshman class? What happens to tuition? So all of these things in every one of these pools of capital has to be considered. And that's that sort of calibration, both of what's happened and what's happening on the other side of the balance sheet. They then will look at their own managers and their own portfolio and say, is anyone calling for the ball of the managers they've already allocated money to? And there's been some of that activity. And then the last piece will be, are there long-term structural opportunities, as you say, tactical opportunities to take advantage of? I think people were more excited about that before the bounce in the equity markets, and now are just waiting to see how this shakes out. It's sure, you would think that after shutting off revenues in the economy, that you'll have a wave of defaults. Probably will, unless the government saves everything, but it hasn't happened yet. So spreads are wide, but most people aren't going to do. Most people aren't going to step into that before it feels like the knife is fully fallen.
And I don't mean to be short-sighted, but it makes it engaging conversation, understanding that many gigantic institutions are very, very long-term. Nonetheless, there'll be some long-term perspectives that really may be permanently impacted by COVID-19. Let's turn to one of them and another asset class we're moving to, and that's commercial real estate. You would think gravely impacted and possibly changed forever. Office space, movie theaters, restaurant, retail space, hotels, and perhaps good or potential with greater return, storage, multifamily, manufacturing. Again, I understand the 20 plus year time horizon, but again, in general, in commenting, what are you hearing from the allocators?
Well, I think everyone's asking the same questions you've just asked. I don't think anyone knows the answers yet. We don't know when we come out of this what will change for the long term and what won't. It's people are more comfortable now conducting some of their work remotely. Does that mean they'll want to continue doing that, or are they going to crave being around their teammates more after the absence of it? I just don't think we know yet. So um, it does make sense, and particularly in commercial real estate, that the composition of what's happened in the past will look quite a bit different going forward. I have not heard of people jumping in to make any bets on that based on distressed prices. I think for a while, you're just going to see very, very low transaction activity.
And let's turn our attention to one of the favorite asset classes of many institutional investors, because it does have a very long-term perspective and potential for, again, higher returns and some level of on-correlation. Effectively, it's investing in startups and earlier stage companies, VC. So maybe one question I'll have on that is management fee generally based on uncommitted capital, not invested capital, and the whole structure of the fee structure, mainly in VC, not to pick on it, but high watermarks, charging performance fees on nominal high watermark versus inflation adjusted. What has been some of the perspective of the institutional allocators, and are they starting to dictate more terms to VCs?
It's a fascinating asset class to look at because we've already gone through a decade where the averages haven't generated much of return. And that flies in the face of what most people might think, but that's because the returns are just highly concentrated in a small number of venture capital winners. So it really depends on where you sit in the ecosystem. If you're Benchmark or Sequoia or Greylock or Highland, and the list goes on.
You dictate terms.
So you have excess demand for your product.
Yes.
And so price is price. For the rest, it really becomes a question of supply and demand. So there's a price that's being set for those premium players. And the others, and we already saw this play out in the hedge fund space over the last decade. It just depends on where you sit in the ecosystem, because to some extent there's a market, but it also is a market of one for any one fund. And that's how the price gets determined. So, would investors like the terms to be better? Of course they would. Do they have the power to do that? Well, it depends on the size of their own balance sheet relative to the manager. It depends on their willingness to take a risk with a manager that others aren't willing to, and the important capital. And that determines your relative negotiating power and your relative bargaining power in that negotiation.
Very top heavy to some of the top VC firms that you mentioned. And to get into them is effectively impossible. Almost every LP seems to re-up, even if the vintage is not necessarily so great. They don't want to miss out on the next one. So getting into one of those top 5 or 7 firms, even for $1 billion family, it's just not possible sometimes. They have to look, I'm not going to say it's second tier managers. Those managers that are smaller than some of the ones I noted have potential to, past performance is no guarantee of the future. So maybe those will be the winners moving forward. But I would look at it in general as say, especially sub $1 billion SFOs, VC could be a tough asset class to play in.
Yeah, I mean, you have to take different risks than some of the people you read about in the papers are taking. So, and that's kind of true to some extent across asset classes. That there are investors like where I started my career at Yale that are very comfortable backing a new manager. And in fact, most of their relationships have come from that and lasted for decades. And so most allocators are not. Most allocators want to see a track record of success in that organization before they're willing to go in. And in venture in particular, that's, as you said, that's just not an option.
Turning attention a little bit to the energy markets, which have gotten beyond hammered. Has it bottomed? Who knows? But you look at the long-term prognosis with airlines in jeopardy, with mass transit perhaps being more common, working from home. I mean, that looks like a powder keg of potentially global implications, obviously. Do you see much or many allocators cutting back on their exposure, looking at it again as a dislocation? We have a thesis it's going to go up. And again, 20, 30-year time horizon long term.
So yes, allocators are thinking about the energy space quite differently than they had in the past. And it's really through an increasing importance of the lens of ESG and sustainable investing. I think that there will be an increasing disparity in sort of renewable and non-renewable asset prices and cost of capital for those businesses. So if you look out for a longer period of time, the oil companies, and it's already happened to coal, those companies will experience higher cost of capital going forward. The businesses will be worse as a result. And so, yes, you are seeing a shift away from some of those real asset investments of old and towards things that have a more sustainable lens.
We'll switch over to an asset class that you have just a little bit of experience with. In my backyard of Greenwich, Connecticut, a very, very common one, and one that for the most part has had not the best 10 years or post the financial crisis from '08, and that's hedge funds. You would think, depending on the strategy of the hedge fund, should it live up to that terminology hedge? And if it's long short, go down less, but perhaps not go up as much during challenging market dislocations that we're having now. But are many managers really good at shorting? Probably not. Or although it doesn't fit the moniker of the term hedge fund, simply they're more concentrated alpha players that look to outperform the market. Henceforth, if you're 2 and 20 and you're a taxable investor, it doesn't look too attractive unless they could prove to you, or you have very strong reason to believe, that they're going to outperform. What's your opinion, and what's the allocators' opinion, institutional allocators, on hedge funds?
Yeah, well, I think that's a very fair critique. Almost all of the institutional capital is tax exempt.
That's a huge play in the hedge fund world, yes.
And so there is a big difference in the appropriateness of most hedge fund strategies for taxable investors, much less favorable for a taxable investor. Hedge funds as a group are pretty heterogeneous. People talk about long short, but that's not really the core of where most institutional investors look for hedge funds, right, as diversifying strategies. They may include long short in their equity allocations. And it's a catch-22. You do have some of the most well-compensated, smartest, hardest working investors in the public markets sitting in a hedge fund structure, but that structure is very expensive. And competition has gotten very, very high. And particularly in long short, it is very difficult to add value shorting. So what are you left with? And I think, increasingly you've seen allocators struggle to make new commitments to long short funds. They may keep the ones they've had for a long time, which is what's driven a very healthy continued industry. It's like 3 trillion in assets now. But like any industry, as it matures, you have concentration into kind of winners, and you have a whole bunch of players that struggle to stay alive. And that's what's happened in the hedge fund space.
Yeah, I mean, there's trillions of dollars in hedge funds if you just go by that math, but it tends to be very concentrated in the top 20. If you want to be a little more broader, the top 50. And like you said, because of the taxable implications, it tends to be much more popular with the institutional investor community as opposed to taxable families. Moving our attention a little bit to one of the more common asset classes as well, with many institutional level investors, is private equity. Again, long-term in perspective, but what are some of the trends you're seeing among great allocators in private equity?
Yeah, so private equity has been a fantastic place to be. I've made the case that we've just seen peak private equity, because all of the precedent conditions going into what's been a very strong period for, whatever it is, 10, 15 years, are one by one reversing. So, and you're seeing that in the institutional community. People are still making commitments to their favorite funds, but they're favoring middle market buyout shops over large buyout shops. They're looking further down for the types of characteristics that led to success over the last decade, rather than the sort of keeping the same playbook. And this current COVID-19 crisis is going to be kind of an interesting test case, in the sense that you could compare hedge funds in 2008, where you had call it a stop of the financial system, which hedge funds were quite reliant on. And there were things like the triggering of Gates in 2008 that upset some investors, and you had sort of Bernie Madoff and all these kinds of one-off things that ended up looking like a tipping point in retrospect. And there's a good chance that if the private equity industry isn't careful, that the PPP plan and government funding of businesses is going to have the same negative connotation when looked back. And the reason for that isn't that the businesses shouldn't take bailout funding. They need it. The economy has to keep going when this is over. It's that in the transition of that, the private equity firms stand to earn a carry, and that may not look good as we look out. And so that just may be a tipping point, that when you look back, it does take a longer time, but you look back 5 or 10 years from now, and multiples for businesses are high, credit spreads are wider, rates are still very low, but credit spreads are wider. Economic growth will inevitably be slower because of the money we've had to take on to make it through this period of time. And those are all conditions that really will make it difficult for private equity firms to continue to generate anywhere near the kinds of returns they did in the past.
This will relate a little bit primarily to VC, but also to hedge funds and private equity as funds. So one of the things that we brought up, and some of the chats coming in from the single family offices here on Zoom, is the best of the best tends to be very crowded. People re-up. There's not a lot of room, especially in VC, but some of the others as well, for even wealthy families and big SFOs to get into them. But there is one way, and it was on my list to bring up, and that would be through fund of funds. So fund of funds have gotten beaten up as additional layer of fees, and perhaps rightfully so. But there are certain circumstances, if the best of the best in VC so outperforms everything else, and you have no other way to get in, that could still be an opportunity to get into a fund you want to get into. With additional fees, I get it, but it may be worth it.
Well, I think you have to start with your belief system, like in any investment strategy. So if you start, let's say in the venture world, with the belief that the only way you get returns in venture is through the very, very best funds, you actually won't invest in a fund of funds, because those best funds don't take money from fund of funds either. If you believe that digging through lots and lots of wheat and separating the wheat from hay and separating the wheat from the chaff is a valuable exercise, and you don't have the resources to do that, those are the opportunities where using a fund of funds may prove very beneficial. The costs are higher, but with those costs, presumably you are paying someone to exert their experience, judgment, and spend that money on research. So it really depends on what you believe creates success in those asset classes, and then following through on the appropriate strategy.
How do institutional level investors think of commodities? How are they investing in it? Through ETFs, through managers? Is it simply just a hedge?
Yeah, most institutional investors with very long time horizons try to own equity-oriented assets.
Right.
So where you see commodities tend to be more in different ownership of businesses, where the management of the business more than the commodity itself will generate the returns. So historically, you saw that in oil and gas partnerships. You'd see more operating partnerships, almost like private equity in the space, than you would venture or exploration development partnerships. So some of both, and that's it's true of timber assets as well. And trees grow, and when they grow, their value grows geometrically, and that's a a very attractive asset at the right price for an institution with a long time horizon. So some of those activities are still in place, but it really, the institutions focus more on who the practitioners are and how they can add value than just the commodity and the commodity price itself.
And perhaps now the most well-known of commodities playing out in today's environment, gold. Specific opinion about gold, or how are, again, you talk to so many amazing investors, and I understand it's going to be different per se with an institution comparative to a family. Are you seeing a difference about how they're incorporating gold into their portfolio?
Gold's always had sort of binary views. There are some people who have a, low to maybe mid single digit percentage holding of gold because they believe that that fiat money has been debased and that gold is a good hedge against that. Some of those people now own some Bitcoin as well for the same reason. But there are many more who don't see gold, or Bitcoin for that matter, as a productive asset to own, and think the opportunity cost of holding it relative to holding some share of economic growth through presumably a business is worth it for a long period of time. So there are two camps, and I think those two camps remain. It's not hard to see as gold goes up, people are going to spend a little bit more time thinking about whether that's a valuable hedge in a world where historically the structure of portfolios, maybe it was 60-40 or 70-30, but whatever bells and whistles you want to put on for asset classes, there was a risk structure that was a stock bond portfolio where the bonds hedge stocks. And that's not going to work with bonds at zero. So people really have to think carefully about what might replace that hedge, and gold is one of those options.
Very good comment. You actually segue pretty well into the next asset class, fixed income, treasuries, bonds. I mean, that could be a really complex market to navigate if you look at it tactically in the short run. What are you seeing?
I mean, we just need to see where things shake out, right? It's particularly in the credit markets, you'd expect that there'll be some dislocation.
Yes.
And it hasn't happened yet, and the government is providing as much of a safety net as it can. But once that happens, I do think there'll be opportunities. Now, where will they come? That's hard to tell. Is it in distressed corporate credit? There's a good chance. Will there be problems in structured credit? Probably, if it's tied to the same underlying corporate credits. But it's not quite there yet. There are some prices that are cheap, but this is a tough time to be bold.
And broadly more esoteric assets, which in theory you think will go lock in step with equities and real estate, yet commonly they do, but in theory, potentially a hedge. You mentioned one of them, timber, land. Why don't I just throw in, although more of a counterpart to gold, cryptocurrencies, cell phone towers. I mean, there's some very unique investments out there that, and some of them may not necessarily be correlated even to the dislocation that we're going through now. I'm assuming families could be more nimble than many institutions. They don't have the layer of committees, consultants, and that could be good. I'm going to say it is, but it could be bad. Maybe they make rash decisions too quickly.
I think both of those are true.
And in terms of families investing in those type of asset classes, from your experiences with the family office and others that you talk with, are you seeing them be more active in those type of asset classes to generate returns in tough markets?
There's been a wave over the last couple of years in looking for, let's call it yielding assets that aren't correlated to the equity and credit markets. So things like litigation finance and pharmaceutical royalties and a whole bunch of other, maybe cryptocurrencies and crypto assets fall into that to some extent. So I think there has been interest in a lot of other ways of generating returns, and that will continue.
Maybe we'll go back a little bit to some of your deep experiences with hedge funds. And I agree, it tends to get a little too pigeonholed into long short. It's much deeper than that. And the topic for a different discussion broadly on hedge funds in the future. But in theory, any type of fund, whether private equity or venture capital, although scale in venture capital appears to be somewhat impactful, like we said, But there was a belief, mainly in hedge funds, that many of them have gotten too large. They're asset gatherers. They're there to placate to more conservative institutional investors that don't have to worry about taxes as well. Again, a huge advantage. But that families would still be better investing in earlier stage managers. But I'm assuming you're taking on way more operational risk. Simply, they may fail. But if you go by the numbers, and averages could be devious as well as deceiving, they have gotten in the past higher returns than some of the larger managers. And this may go back to what you were doing at Protege. Do you think there still is opportunities for families and institutions to be early stage investors, or only should they do it if they get favorable terms?
Sort of loaded questions, but good ones. I don't think there are easy answers. No one wants to invest in all of the small hedge funds. No one wants to invest in all of the large hedge funds. No one wants to invest in all of the hedge funds. What you find is it's a fairly unique category, and you think Michael Movison talks a lot about base rates. It's interesting that people are interested in creating allocations to a group of managers in a category that they don't want and don't like. I don't think I've talked to anyone who says hedge funds are a great place to be. Almost all of them say, well, we don't really like hedge funds, but we do like our hedge funds. So it's very difficult as a result of that to generalize about, oh, large funds are good, small funds are good or bad or whatever it is, because nobody really wants any broad category. I spent a long time in the smaller fund area. What I could tell you is that none of the math of the statistics are done well. They all are done over a wide enough swath of managers that it's not a representative universe, and there's a massively wide dispersion of outcomes. So in order to invest in that area, you have to feel like you have some competitive advantage as an allocator. You have to feel like there's a reason why you're going to get it more right than the average. And that happens both in the smaller side and the larger side. I do think that the larger funds are more institutional, and the institutional return requirements are probably, or return objectives are probably lower in those strategies, in many of those strategies, than they might be for individuals. And so it's entirely possible that you have a fund that's appropriate for an institution that's less interesting for an individual. I don't think that necessarily lends itself to, oh, therefore you should go invest in a startup hedge fund, because a startup hedge fund doesn't have a startup venture capital type reward profile. They're still investing by and large, maybe a broader opportunity set, but they're still investing in the public markets. They're still competing in a very difficult marketplace to win. So, it really is incumbent on each individual investor to decide where they think they have expertise and what they're trying to achieve through those investments.
In general, the subject of diligence when you're investing in third parties and not being a direct investor, but again, investing in funds, for lack of a better word, as an LP. I'll give a little bit of a shout out. We completed it right about the time COVID-19 was starting to take place. We commissioned and published, it's like among the most comprehensive due diligence on alternative managers. It basically is a 50-page ebook. My members, I have posted it. I don't know if anyone reads anymore. We're getting bombarded. But those of you that are listening in or hear this in a podcast, if you send me an email, I'm more than happy to share that investing or due diligence on alternative managers. It is very, very comprehensive. It's a dense read. There's a truckload of checklist. The person who was the lead author, some of you know, Rishi Ganti, a friend of mine, but we were really excited to commission it and publish it. And we will have him on the show about that topic. But if you wanted a little bit of a head start, it's up there in the member portal, or simply just email me. In times of challenge and dislocation, the financial crisis, what we're going through now, always after the fact, you'll have families, CIOs, damn, I kind of saw it coming, but I waited too long. What could I have done to hedge against the fat tail risk, against this black swan event? And the person who kind of made that term popular in his book, Anti-Fragile and Others, Nicholas Nassim Taleb, his Universa fund is doing utterly fantastic. Are you seeing institutional investors put a small amount of capital, I don't know, 1 or 2%, towards something that is going to basically be zero, but once every 10, 15, 20 years, when it goes to hell in a handbasket, it's going to go up like 3,000%?
Well, clearly the time to do that was a few months ago, right?
Yeah, it's a little too late, I think.
And this happened again in 2008 and 2009. In 2007, 2008, early 2008, all forms of financial insurance available in the markets were ridiculously cheap. Yeah, I remember a manager once telling me that Japan CDS was trading at 2 basis points, and nothing should ever trade at 2 basis points. You could buy CDS on corporates. You could buy, implied vol was like 10% in the market. You could have loaded up on insurance very cheaply, but nobody started talking about tail risk insurance until probably mid 2009. And by the time this rolls around, you see things like what happened at CalPERS, where people just get tired of paying negative carry and they cancel their program right before it would pay off. So no, I don't see people right now talking more about buying protection because the price of that insurance has just gone up quite a bit.
We have a question that came in from the chat feature. Ted, what happens with operational due diligence? Typically, alternative investments have generally involved an on-site visit. How do I do that on-site when I can't leave the house?
Yeah, I mean, people are using Zoom. And if anything, the institutional teams are getting more ramped up in their operational due diligence than they are in their investment due diligence. And the reason is that most operational due diligence is sort of black and white, in the sense there's a long checklist of things that an investment manager should be doing, and they're either doing it or they're not. They either have dual signatories on their wires when they go out, or they don't. And so I've heard repeatedly that a lot of the institutions are making sure they backfill and complete and dive deeper on operational due diligence because they feel like they can effectively do that on Zoom in a way that it might be a little bit harder to read nuance in qualitative assessment of managers.
Yeah, it's not directly to that question, Chris, or to what Ted just commented on, but I will comment a little bit. Very, very intriguing times, and obviously challenging for many of us, both personally and in business, and doing diligence, especially maybe a little less so with managers, more so in real estate and in startups, has become harder. We do have some families that actually have done drones, that have done local, they're a legal firm hiring someone local on the ground to do a site visit, take pictures, Zoom, like you noted. So those are all things where people are getting creative. The core point I'm making is many family offices have gotten staid. Many of them have technology that is not keeping up with the times. They kind of know this. They had a plan or have a plan in the future to do something about it. And what COVID-19 is doing is it's forcing them to confront it right now. And what some of them are realizing, a little bit with some of what we're writing and what I'm helping some families on, it's not that bad. Learning how to use Microsoft Teams and Slack for communication, learning how to use project management tools, how to leverage CRM, if you have aggregation and reporting. Some of what's happening now, when we're by COVID, past it, whether it's 6 months or 3 years, and I think it might be a little longer than I was hoping for, but we'll see. I don't know about 3 years, but probably not 6 more months. There's going to be some positive things moving forward in the family office. It is going to get more virtual. It is going to leverage these tools, which people in my age bracket are realizing they're relatively intuitive. They're not that bad. And they actually improve a level of experience for employees. Imagine having a family office in Palo Alto and maybe having middle-level people that can't afford to live there. It's difficult for them to travel in. They're starting to look for other jobs. If they're able to be remote and it's more effective, which is not easy, but certainly more efficient, this really creates an opportunity to adapt to today's times, that single family office. Ted, I see we're coming somewhat towards the end. I don't know if you had a parting comment of insight for our listeners of the podcast. So please feel free to share, as well as how people can learn more about your podcast and what you do.
Sure. Well, my podcast is called Capital Allocators, and I have a website, capitalallocatorspodcast.com, that has all, I don't know, 150 or so episodes linked to it. This is a really interesting and difficult time for everybody, and I think it's only increasing in that as time goes on. So I've had a number of conversations with people about it, and the one thing I would leave as a parting word is slow down and find ways to be creative, because this time is just a terrible ordeal. But we'll all look back and think about what we did during that time and where there are opportunities to do things that you haven't done, take advantage of it.
Well, you thought you were finished, Ted, but one question came in, and it's not an easy one. In summary, where do you see the best opportunities if one has a 3 to 5 year time horizon?
Probably emerging market equities and small cap value in the US. Small cap value in particular. There are going to be companies that don't make it through, but those stocks haven't bounced back. And I think there's going to be a lot of opportunities there.
Very good insight. I now have to do a close from my side, and we'll say goodbye to Ted, who was a wonderful guest, and I thank him so much for being part of our podcast today. Everyone, I'm Angelo Robles, the host of Angelo Robles's Effective Family Office Podcast, and thank you all for viewing or listening in. And I'm the founder and CEO of Family Office Association, among the world's largest membership organizations dedicated primarily to the interest of single family offices. We do a significant amount of proprietary content. We have an online portal for member-to-member communication, sharing content, our online meetings, and more importantly, peer-to-peer connectivity. We host a lot of events. Those are a little bit on hold, but we're hosting now even more daily online meetings, which have been incredible for our families and SFOs around the world. I'm easy to find on social media, on LinkedIn, on Instagram, etc. FamilyOfficeAssociation.com or AngeloRobles.com, and preferred email is angelo@FamilyOfficeAssociation.com. Thank you all for listening in live. Thank you, Ted, for being a great guest, and all of you that hear the podcast or see the video. We hope you enjoy it. Have a great day and stay safe, everyone. Thank you.